Dear friends, welcome to another video, and here we are going to briefly look at the concept of capital structure, and we will look at the theories of capital structure, namely net income approach, net operating income approach, and Modigliani-Miller approach. And I'm going to solve a problem on for each approach, and in this particular video we will solve a problem on net income approach. Now, what is capital structure? According to Gerstenberg, capital structure refers to the makeup of a firm's capitalization. In other words, it represents the mix of different sources of long-term funds such as equity shares, preference shares, long-term loans, retained earnings, etc. in the total capitalization of the company. So, capital structure is nothing but a proportion of debt and equity. A combination of those various components of capital is called capital structure. And now, what is the relationship between capital structure and firm value? Now, since the objective of any firm and financial management is to maximize the value of the firm by maximizing shareholders' value. So the capital structure here is very important because if you have an optimum capital structure, it means the firm is able to maximize the value of the firm as well as minimize the cost of capital. That is the objective here. And so what is the relationship between capital structure and cost of capital? What is the relationship between capital structure and firm value? All right. And so we are going to look, we are going to look at the relationship between capital structure and firm value, as well as capital structure and cost of capital. But before that, we are going to look at some assumptions. And the first very important assumption here, before we delve into the relationship between capital structure and firm value or cost of capital, we will first make these assumptions. Number one is that there is no income tax, corporate or personal. Number two, the firm pursues a policy of paying all its earnings as dividends. In other words, the firm does not keep any retained earnings. 100% is paid off as a dividend. And another thing is that the debt capitalization rate, KD, debt capitalization rate or cost of debt, KD, and the equity capitalization rate or cost of equity, KE, will remain constant over time. Investors have identical subjective probability distributions of operating income for each company. Now, what do you mean by that? It means, all investors, we are assuming that all investors have identical expectations when they invest in firms. Now, that is not true at all in reality. All right. And the operating income or EBIT is assumed, not expected, is assumed to be constant over time. And another assumption is that a firm can change its capital structure almost instantaneously without incurring transaction costs. So if I want to change my debt equity ratio, let's say from 1:1 to 1:2, I can do it in a flash without incurring any transaction costs. All right. But again, in reality, that is not true. Now, the rationale for the above assumptions is to abstract away the influence of taxation, dividend policy, varying perception about risk, growth, and market imperfections, so that the influence of financial leverage. What is financial leverage? Financial leverage, as I've mentioned in the leverage videos, is nothing but the presence of fixed financial costs like interest. All right. So that the influence of financial leverage and cost of capital can be studied with greater clarity. And here are a few definitions. Okay, KD is equal to I by D. Now, don't worry about all this. While solving the problem, I'll be again touching on these things. So, what will happen to KD, cost of debt, cost of equity, KE, and the overall cost of capital, KO, when financial leverage, the debt equity ratio changes? And we are going to answer that question, okay, with the help of the first approach, that is the net income approach, which has been propounded by David Duran. And according to David Duran, the capital structure of a firm is relevant. In other words, a change in the capital structure will cause a corresponding change in the overall cost of capital as well as the total value of the firm. And according to David Duran, he says that, if you bring in more debt into the capital structure, the overall cost of capital will decrease when you increase the debt value, when you increase the debt equity ratio of a firm. So, according to NI approach, the capital structure of a firm is relevant. All right. Now, how are we going to prove that? See, according to NI approach, as the debt equity ratio, the financial leverage increases, all right, the cost of equity is expected to remain constant, as well as the cost of D, but KO will decrease, all right, over time. Now, we are going to prove this with the help of a problem, an illustrative problem, and here it is. Assume that a firm's EBIT is rupees 20,000. The cost of equity KE is 15% and the cost of debt KD is 10%. Its total capital amounts to rupees 2 lakhs, assuming that the firm can have the following alternative degree of financial leverage. Okay, this is the leverage, that means debt to total capital: 0%, 20%, 50%, and 80%. Compute the cost of capital and value of the firm for each alternative leverage using the net income approach. So let's solve this problem, all right, using NI approach. And always remember, I'll just draw it here somewhere. So according to NI approach, as the debt equity ratio increases, all right, as you bring in more debt in the capital structure, KE is expected to remain constant, as well as KD, cost of debt. But what will decrease is the KO. So we're going to prove that with the help of this illustrative problem. All right. So first things first. First things first. We are going to define a few things here. All right. Where V is the value of the firm, and value of the firm is equal to D, which is market value of debt, plus E, market value of equity. All right. And KD is nothing but interest payment, okay, divided by the market value of debt. And KE is nothing but their equity earnings, all right, equity earnings divided by market value of equity. And KO is nothing but operating income, EBIT, divided by the market value of the firm, V. All right, remember those things. So here, let's computation of equity earnings. All right. All right. Now, let's solve this problem. Okay, we're going to look at the four options here. The leverage, debt to total capital, all right, where the debt is 0%. D is 0% here. Here D is 20%. Here D is 50%. and here D is 80%. All right. And so what will be the value of debt? Of course, it will be equal to 0. Now here, what will be the value of debt? Now this will, it is 20% of the total capital. All right, that is the total capital. So the total capital is 2 lakhs. So 20% of that is how much? All right, 20% of that is 40,000. So your market value of debt is 40,000. Here, debt is 50% of the total capital. All right. So here 50% of 2 lakhs will be 1 lakh. And finally, okay, don't mind. I think you can hear, the dog barking in the background. Just ignore that. All right, that's my dog barking. God knows what is he barking at. All right. Okay, and so here D is 80%. All right, the leverage is 80%. So that means the market value of debt will be 80% of 2 lakhs, which is 1,60,000. All right. Now, so your equity capital here, since debt, all right, let's call this D, this is E. Here the equity capital will be what? It'll be 2 lakhs. Why is it 2 lakhs? It's because the debt capital market value of debt is 0. All right, now another thing, remember that when there is no debt in the capital structure, the EBIT, when there is no debt in the capital structure, that firm is known as an unlevered firm. UNLEVERED, unlevered firm. Again, I'm repeating, when a firm that does not employ debt in its capital structure is known as an unlevered firm, and a firm that employs debt in its capital structure is known as levered firm. So in the first case, the firm here is unlevered because it has no debt, but here it has a market value of debt of 40,000. So obviously the market value of equity will be what? Will be 2 lakhs minus, it'll be 2 lakhs minus 40,000, it'll be 1,60,000. All right. Here the market value of debt is 1 lakh. So obviously the market value of equity will also be 1 lakh. Here the market value of debt is 1,60,000 and the market value of equity will be only 40,000. All right, only 40,000. Okay. Now, so show EBIT. Now the EBIT operating income is 2 lakhs. Oh no, sorry, 20,000. Minus interest. All right. Now what is the interest rate here? KD is 10%. KD is 10%. All right, KD is 10%. So 10% on what? 10% on the debt capital. All right, now 10% on 0 is 0. All right. Now 10% on 40,000 is 4,000. 10% on 1 lakh is 10,000. And 10% on 1,60,000 is 16,000. All right. And so your equity earnings will be what? Now, why is it equity earnings and not EBT, earnings before tax? It's because we have already made an assumption that there is no tax and there's no preference dividend here. So EBIT minus interest is equity earnings. So this is 20,000. So this will be 16,000. This will be 10,000. and 4,000. All right. Okay. Now, we're supposed to find out, compute the cost of capital and value of the firm for each alternative, leverage using the net income approach. All right. So now, what is the market value of debt? Market value of debt is given. All right. So D, wait. Let us first compute the, market value of debt. D is equal to interest divided by KD. All right. And D is already given. We've already found out. So D here is 0. It's nil. Here it is 40,000. Here it is 1 lakh. And here it is 1,60,000. All right. And market value of equity, E, is equal to equity earnings divided by KE. All right, divided by KE. So what is the equity earnings here? Let us find out. Now in this case, in the first case, what is equity earning? Equity earnings is KE. Oh, sorry, cost of equity is KE and equity earnings is 20,000. All right. So what will be the market value of equity? Again, equity earnings here is 20,000. KE, all right, it's already given 15%. So what will be the market value of equity? So let's find out. So equity earnings, 20,000 divided by 0.15. That is 1,33,333. All right, 0.33. All right. Again, for here, we need to find out what is market value of equity. So 16,000 divided by 0.15. That is 1,06,666.67. All right, 0.67. And here 10,000 is there. Equity earnings 10,000 divided by 0.15. So it's 66,666.67. And finally 4,000 divided by 0.15. You'll get 26,666.67. So that is your equity earnings. Now let us find out the market value of the firm. Now what is market value of the firm? V is equal to D plus E. All right, we know what is D. We also know what is E. So D plus E is equal to 1,33,333.33. Same thing here also. 40,000 plus 1,06,666.67. You'll get 1,46,666.67. Again here it'll be 1,66,666.67. Again it'll be 1,86,666.67. So there we have it. Okay, the value of the firm. Okay, now so we're supposed to find out the total market value of the firm as well as the cost of capital. Cost of capital, KO, the overall cost of capital. And what is KO? KO is equal to EBIT divided by V. Now alternatively, let me show you here. I'll just write another formula for KO. KO can be found out, okay, through this formula. KO is equal to KD into D by V plus KE into E by V. That is another alternative way for finding out KO, the overall cost of capital or weighted average cost of capital. Now here KO will be equal to EBIT divided by V. All right. Now what is EBIT? EBIT is 20,000. And what is V? V we have found out. So in this case, in the first case, it's going to be, KO will be equal to EBIT 20,000 divided by 1,33,3, okay, 33. Same thing here, it'll be 20,000. EBIT does not change. That is the assumption, remember. Operating income remains constant over a period of time. Again, oh wait, 186.67. So this will be equal to okay, this will be 15%. Okay, here this is 13.6%. This is 11.9%. This is 10.7%. So you will notice one thing, okay? It is very clear that as the financial leverage increases, as the debt equity ratio increases, your KE remains constant, KD remains constant. What will happen is KO will decrease, all right? So here we can see, as the debt equity ratio increases, the financial leverage increases from 0%, 20%, 50%, 80%, you will notice that the overall cost of capital KO, all right, decreases from 15% to 13.6%, 11.9%, and 10.7%. So here we can say, right, from 0%, all right, from 0%, KO remains at 15%. But as it increases, okay, let's say, to 20%, 50%, and 80%, okay, you'll notice that your KO has decreased, okay, to 13.6 to 11.9 to 10.7. So that proves, the theory that, the capital structure of a firm is relevant, that when you increase the debt capacity, all right, in the capital structure, your overall cost of capital will decrease. Now, if you notice here, for an unlevered firm, 15%, all right, is the KO. Now, that which is equal to KE, 15%. So, in other words, for an unlevered firm, let me write here, for an unlevered firm, you know what is unlevered firm, right? A firm that does not employ debt in its capital structure. So, for an unlevered firm, KO is equal to KE. Always remember that. KO will be equal to KE. So this is the problem. So I have proved, right, that, through this problem, that as the debt equity ratio increases, the overall cost of capital KO will also, will decrease. As the debt capacity increases, KO decreases. All right. Now stay tuned for the next couple of videos.